Hi, good morning, everyone. Welcome to today's session where we will be taking a look at trend indicators. Right, your presenter for today is me, Isaac, and I'll be doing this on behalf of Mr. Avramis Despotis. This is a collaboration between Tradepedia and Everest Fortune Group. Now, before I begin, I just want to do a quick check, audio-visual check with you guys, right? Make sure that you guys can see the slides. Okay, so you should be seeing Mr. Avramis' handsome face right there. And you are able to hear me loud and clear as well. If you are able to, please leave a question, leave a comment in the question box below. Right, so a simple Y or yes would do. All right, thanks so much, Jess, for the quick reply. So really appreciate the quick reply from everyone. Setiong, thank you. Harry, thank you. Yok, thanks a lot as well. All right, so we do have a good number of people in the room today. And let's quickly begin. I don't want to waste too much time because there are quite a number of slides that we want to go through. Okay, and I think trend indicators are really important. Okay, not the most important, but one of the more important things to understand. And I hope that whatever I share today will be able, you guys will be able to add it, you know, into your trader toolbox, right, and be able to make use of it. Okay, and if you guys already know, the style that I do this presentation is without any Q&A session at the end. If you guys have any questions at all, feel free to go through. Feel free to fire your questions right in the question box along the way. Okay, I will do my best to reply you guys along the way. Right, it beats, you know, just keeping the question in your mind and then waiting to the end. And by the time, your questions may not be very fresh, may not be what you really want to ask at the end of the day. Okay, again, there will be no recording provided for this, but feel free, right, to record this or to actually take screenshots as well. Okay, so I will try to use a bit of the pointer, do a little bit of writing, pointing here and there. So it'll be good if you guys can take your screenshots. So let's begin. Today we're going to be covering trend indicators. More accurately, in this webinar, what you guys will be learning, right, will be moving averages, how to calculate moving averages, how to interpret them, and then if there's time, right, we will move on to MACD, right, it's the moving average convergence divergence indicator, and then we'll also talk a bit about the MACD histogram. Okay, so I have a couple of you over here. I just want to know, right, what is the experience that you guys have with using trend indicators? Okay, so do you guys, how do I phrase this? Do you guys use trend indicators? If you guys use, right, just let me know the name of the trend indicator that you guys actually use as part of your trading. If you guys do not use, just, you know, you don't have to reply, or you can just type a NA for not applicable. All right, so mostly we look at MACD, okay, and then we look at RSI. All right, Usman, thanks for your quick reply once again. But I have to point this out to you. Okay, RSI is not a trend indicator. Okay, RSI is not a trend. It is an indicator, but it is not a trend indicator. Okay. Do you guys use any other indicators? Jess, okay, you use MACD, so fantastic. I will cover MACD later on. All right, okay, so yes, exponential moving average is being used. All right, so that's fantastic as well. That is one of the most traditional trend indicators that we actually have out there. In fact, I think it's the most reliable trend indicator out there, right? Moving averages. Okay, so most of you do use indicators, so indicators are definitely helpful, right? Let's dive in to understand a bit more about moving averages. So what are moving averages? Moving average, as mentioned, right, from this topic, is really a trend following indicator. It does not predict future market action, but follows it. Now, there are hardly any indicators out there in the market that actually allows you to predict future market action. Okay, the basis is because technical analysis is a study of price, right? It's a study of price. Now, all indicators out there, right, generally takes their data from price. And if there's no price on the chart, then the indicator cannot calculate the next data. So Generally speaking, most indicators are lagging indicators. There are very few leading indicators from a technical analysis standpoint. Okay, so remember, moving averages does not predict future market action, but rather follows it. Otherwise, it's also called a lagging indicator. So MAs are also used to identify the direction of the trend and define potential support and resistance levels. It can therefore be viewed as a curving trend line. All right. However, moving averages may not be very useful, right, when price shows huge whipsaw actions. So there's a lot of huge whipsaws where price chops around the moving average, and that is to the detriment of the trader who is using moving averages. Okay, so now we just move a bit into calculating the moving averages. Right over here, we have the period and the price, where price is at. Okay, so this is the chart. Okay, and these are the candlesticks. So for example, let's say we are calculating a 3-day moving average. And this is what we are trying to calculate here is what we call a simple moving average. Let me just change the color. So we're looking, there are many kinds of moving averages, okay? So there is a simple moving average, SMA. All right, there is the weighted moving average, WMA. There is the exponential moving average, which Usman shared with us earlier, and he's using it as well. So it's called the EMA. And then, of course, there is the slightly rarer one, which is the triangular moving average, okay, which really triangulates prices, right? So this is very rare. I don't think we should spend time on this at all. Okay, hardly people actually use it. All right. So moving averages. Let's say we're calculating a simple 3-period moving average, SMA, right? So in this example, okay, you can see that the closing price, okay, for example, the first period closing price is 20. All right, so 3-period, okay, moving average, SMA over here. What it takes, how it's calculated is very simply, okay, let me just bring out all the points. Okay, I just want to show you guys the points. Okay, so this is a 3-period, the black line is a 3-period moving average. Okay, so let's say the first period candle closing price is 20. Okay, so if we are doing a 3-period look back, we actually take the most recent, okay, the most recent 3-period moving averages. Most recent of the closing prices of the 3 periods. Okay, so that's, we take the period 1 closing price 20, we take the period 2 closing price 19, and then finally on the 3rd period, right, we take the closing price 18. Right, so we take 18, we take the sum of this, 18 plus 19 plus 20, okay, and then we divide it by 3 to get the first data point, right, which is the 19, the value of 19, right, and then it is plotted over here, the value of 19, it is plotted over here. So now we have the 4th period being implemented. Okay, what happens is, let me just change the color. What happens is the moving average will drop the latest, the oldest data point. All right, so it ignores the number 1. Okay, and then now it takes into consideration the 4th period. So it will take 19 plus 18 plus 17 divide by 3 to give you the next number, 18. Okay, so we plot 18 over here, right, and so on and so forth. Okay, let's say the 5th period data appears. The moving average will drop the oldest data point and take the most recent 3. So it takes 18 plus 17 plus 16. Divide by 3. Okay, we get the data 17. And then it's plotted on the chart. Okay, so this process happens. It's like a rolling window for those of you who are statistically trained, right? It's like a rolling window average sort of thing. So it always drops off the oldest data, takes in the latest data, the most current one, and then it plots on a graph, and that is how we get the 3-period moving average. Now, let's say we are calculating a 5-period moving average. Okay, the idea is exactly the same, right? We take, for the first period, we don't see anything. Second period, we don't see anything. Third period, fourth period, nothing. All right, because the moving average is actually calculating all these 5 periods. It divides by 5. Let's say we're using the simple moving average again. All right, it divides by 5 to give us the first value of 18. Okay, and then the first point of the moving average will start. This is the first session, second session, third session, fourth, fifth. Okay, the moving average will start on the 5th session, right? And that is essentially how it's calculated, right? So the red line here is the 5-period moving average. Okay. So before I go on to the different kinds of moving average, okay, where we have EMA, WMA, right? I just want to cover this slide first, right? So some of you may have the questions, how many period to average, right? The critical element here is to be able to know what is the number of time periods that should be used in calculating the average. So the key to find a moving average, the key is to find a moving average that will be consistently profitable. Generally, I'll say generally because there's really a lot of styles of doing this, right? Generally, short-term traders use 5 to 25 period moving averages. Medium-term traders use 26 to 49 period moving averages, okay? And then long-term traders use 50 to 200 period moving averages. Okay, so if you guys are new, you guys will hear, oh, price has crossed 200 moving average, or price is approaching the 200 moving average, right? But what I want to encourage you guys to do is to try to think a bit deeper, understand why people are using these numbers for moving averages. Okay, what does the 50 moving average represent? Okay, is it just an arbitrary number? What is the 200 period moving? What does the 200 period moving average represent? Is it just an arbitrary number? Most of the time, it generally is it is an arbitrary number, right? Most of the time, it generally is an arbitrary number. However, okay, why people traditionally use the 200 period moving average is because it used to represent one trading year in terms of commodity, in terms of equities. Okay, so that's why we actually pick the 200 moving average. Okay, but a 200 moving average on a 1-hour chart these days will not be very, very useful. All right, so as technology improves, as we're able to calculate moving averages on lower time frames, right, you guys will have to start to ask yourself the question, right, why am I using this number for moving average? Okay, so I'm going to go back to the previous slide to show you guys what's the difference. Okay, so as mentioned earlier, there's simple moving average. There is weighted moving average. There is exponential moving average, right? So these are the major ones that I will cover. Okay, now simple moving average, I've already gone through with you guys earlier. Sorry, there was a bit of a connection problem in my mic. Can you guys hear me? If you guys can hear me, just leave a comment in the question box, please. Okay, thanks so much, Jess. Yeah, let's hope the mic doesn't drop off. Okay, so now we move on to the weighted moving average. Okay, using the 3-period moving average for example, okay, let's say we're looking back at the 3-period, all right? I want to keep things simple. Now we are looking at a weighted moving average. Okay, what the weighted moving average does is to give more weight, right, to the latest price data. Okay, so it gives more weight to the latest price data. So for example, we're looking at 3-period moving average. For the first period, because it's the oldest price data, all right, maybe the weight will be a 0.2. Okay, and then the second period, because it's a bit more recent, they will give a weight of 0.3. And with the third period being the most recent data, they will give a weightage of 0.5. So you can see that, okay, there will be more weight given to the more recent data increasingly, right? So how it's calculated, instead of 19, what you'll get is you'll take 20 times 0.2 plus 19 times 0.3 plus 18 times 0.5. And then the moving average for the third period, right, will be slightly different. Okay, so I'm not a super math whiz, so give me a while to just calculate this. Okay. All right, and plus 18 times 0.5. All right, so instead of 19, what you get is 18.7. Okay, so you can see that it is a bit more sensitive compared to the simple moving average, which was calculated earlier. So weighted moving average is a bit more sensitive to recent price. Okay, the price of 18.7 is actually closer to the most recent price as compared to the simple moving average. Now we go on to the exponential moving average. All right, what is the exponential moving average? It means that the weight given, its exponential moving average is a bit like weighted moving average, but what it means is that the weight given to the weighted moving average is exponentially a lot more, right? So I'm just going to clear the drawings here because I need some space. So for the first period, perhaps, you know, the weightage is only 0.1. And then for the second, using again the 3-period moving average, and then the second period, perhaps it will be a 0.3. And then finally, the third period, okay, it will be a 0.6. So you can see that the weightage is given exponentially, right, to the most recent price, and that is how they actually calculate the exponential moving average. So you have 20 times 0.1, okay, plus 19 times 0.3 plus 18 times 0.6. Okay, so the exponential moving average, right? This number here, give me a moment, right? 20 times 0.1, you get 2 plus 19 times 0.3. Okay, give me a moment. Okay, plus 18 times 0.6. All right, you actually get 18.5, right? You get the number 18.5, which is closer than the earlier example of the weighted moving average. The weighted moving average value for the 3-period moving average is 18.7. However, now exponential, we get 18.5. So you can tell that it is even closer to the most recent price as compared to both the weighted moving average and the simple moving average. Okay, so therefore, exponential moving average always gives the most weightage to the most recent price. If you ask me, it is a bit more accurate. The good thing is that exponential moving average ignores huge price swings that could skew the data that happened in the past. Okay, that's the reason why exponential moving average is preferred. All right, if do you guys have any questions? Hope you guys are clear. Try to make it as clear as possible. Okay, no questions, let's move on. So after deciding on how many periods to average, the next question when using moving average, okay, will be what is the price to average? Most moving average calculations are based on closing prices. However, there are moving averages that can also be constructed on the high, low, and open price, or they can also construct it based on the median price, which is the high plus low divided by 2, or the typical price, which is the high, low, close divided by 3. And then, of course, it gets a bit more complicated. There's the weighted close, which is the high, low, the high plus low plus close plus, okay, the close one more time, okay, of the most of each period, okay, divided by 4. This is to take into consideration the closing price, to put more weight onto the closing price. Okay, so a triangular moving average, right, is closer to the typical price. It takes the high low close divided by 3. Okay, that's the first calculation, and then they add on the next session, so on and so forth. All right, so it gets really complicated, right? But my advice to anybody who's looking at charts from a technical analysis viewpoint is always to keep things simple. All right, so all these are good to know, right? It's good to know. However, it may not be very useful in your trading journey, right? It's just like baking, I would think. Okay, it's good to know what a measuring cup is used for, but you may not necessarily need to use the measuring cup, right? Coming from an Asian family, everything is agar-agar, cooked by love is the best. Okay, taste the best. Okay, Usman, you have a question. Please explain price filter. Can moving average be used as a price filter? Okay, I think this is not exactly very relevant to what we are covering over here. Okay, the basic use of moving average is to look at the trend, right? Moving averages is not used for filtering out prices. Okay, so when we look at moving average as part of a trend, okay, prices above moving average, okay, prices above moving average is generally on an uptrend. Prices below moving average is generally on a lower on the downtrend. Okay, so there is no way that, you know, moving average can be used as a price filter. I would like to ask you to further clarify your question. Okay, what is the price filter that you have in mind? What are you trying to filter out for? All right, are you looking at the high prices of that session? Are you looking at the median price of that session? Okay, so I would like to know what you are trying to ask by asking about price filter. Okay, so while I'm waiting for your reply, let's move on. Okay, so some of the criticisms of simple moving average. Okay, simple moving average gives some room to criticism, and one of the first criticism is that it is only the look back period that is covered by the average that is taken into account. Okay, so let's say earlier on the example, 3-period moving average, right? It only looks back at the last 3 period. It doesn't take into account anything beyond that, right? So you don't consider the big picture. The second criticism is that the simple moving average gives equal weight to each of the look back period. Okay, so as mentioned in the calculations earlier, right, each of the 3 periods is given equal weight, right? So what happens if, let's say, on the second day, there is a huge earthquake that causes the market to crash, right? And prices drop drastically, then we are going to have a very skewed moving average, right? So those are the criticism. All right, and because of these criticisms on the simple moving averages, right, that is why people actually come out with other type of moving average, which I have also shared with you guys earlier. Right, so the only significant difference between the various type of moving averages is the weight assigned to the data, as shared with you all during the explanation portion of how to calculate moving average. So simple moving average, the SMA applies equal weight. Exponential weighted averages apply more weight to recent prices, right? It's not shown here, right? You just say more weight, but I've showed you guys in the calculation. And then of course there's triangular averages. Okay, there are multiple types of triangular averages, but the most common is the high low close divided by 3. Okay, and then variable moving averages change the weighting based on volatility of prices. Okay, so this sort of moving averages, actually, if you ask me, in my professional opinion, this is something that you guys should take with a pinch of salt. All right, variable moving averages is sort of a fancy name, right, for Bollinger Bands, right? Because Bollinger Bands are sort of moving averages based on standard deviation away from median price point, and also takes into account the volatility of prices. Okay, so this one, please take with a pinch of salt, but it's here, we have to cover it, all right? And it's also good to know. Okay, so let's talk about how to interpret, okay, moving averages. Here we have an example of the bullish price crossover. Now, this is one of the simplest and the most popular method of looking at a moving average and how to use it. Okay, and it's really basically comparing the relationship between the moving average and the security price. So over here, the market structure is very clear. We have prices on a downtrend, right? Prices are making lower highs, prices are making lower lows. Okay, we have a simple moving average that is above price. So as I mentioned earlier, prices below moving average on a downtrend, prices above on an uptrend. So price has made a bottom, right? A bullish signal is given when prices rise above the moving average. So now we see price is starting to cut above the moving average. Okay, and it has gone higher. We can safely say that price has done a bullish crossover to the upside, or we can say there is a breakout to the upside. Now, the safest way to confirm this is always to wait for a close above the moving average, all right, followed by an open above the moving average as well, right? This is one of the safest way to confirm, right? For those of you who are really, you guys are really kiasu or really just want to be very sure, then wait for at least 2 to 3 sessions of close of candlestick closing above the moving average in a bullish reversal. Okay, so over here we have 1 close, 2 close, 3 close, right? Very clear. We have a bullish price crossover or bullish breakout. Okay, the opposite is true for a bearish price crossover or a bearish breakout. Market structure once again is clear, right? Prices are above the moving average. We are generally on an uptrend, and then price starts to reverse, right? The market structure changes, is making a lower high, okay, and then we see that price starts making a lower low, right? And it breaks below the moving average. Okay, so it's the opposite scenario of the bullish price crossover. So this should be pretty simple, right? It's really just getting your toes wet. Okay, any questions on the bullish and bearish price crossover? All right, no questions. Let's move on to the next interpretation of moving averages. So now we're going to talk about the double crossover. What is the double crossover? The double crossover is basically using 2 moving averages to generate signals. So this is called the double crossover method. Now this technique involves using 1 relatively short moving average and 1 relatively long moving average. So for example, you have 1 short-term moving average, such as perhaps using simple moving average as an example, perhaps you have the 10-period SMA, right? So 10-period moving average, and then the long period moving average, you perhaps can use the 50, right? So just giving extreme ends, okay? So the length of the moving average defines the time frame for this trading signal, okay? This double crossover trading signal. Example given here in the slide is the 5-day moving average, 20-day moving average for short term, 50-day moving average, 200-day MA for long term. Okay, so again, you have to ask yourself whenever you're using moving average, like I said right from the start of the presentation, always ask yourself, what is your purpose for choosing this value of the moving average? What is the idea behind using this period that you are looking back on? All right, and that will actually help all of you in your moving average crossover system. So how do we look at the bullish crossover? So let's say price is on a downtrend. Okay, you have the longer moving average, which is the black line. So for example, perhaps this is the 50 MA, right? And then you see the red line, the shorter moving average. Okay, it's the shorter moving average is always closer to price, right? So the smaller the number, the tighter the moving average will be, right? The closer to price the moving average will be. The bigger the number, the wider and flatter the moving average will be. Okay, so the red line here is the shorter term, right? Let's give it a 10. Okay, 10 moving average, right? Now, when there's a crossover, right? When the shorter averages crosses above the longer one, right? So the key is crosses above, right? This is an example of what we call the golden cross. Okay. All right, traditionally, the golden cross was really only referring to the 50 MA and the 200 MA. However, now it's been so watered down that as long as there's a bullish crossover, we call it the golden cross. If there's a bearish crossover, as shown in the next slide, right, a bearish crossover, same thing, 50 MA, 10 MA. All right, if it crosses below, we call this the death cross. Okay, so it's right there, right? So bullish crossover, golden cross, bearish crossover, death cross. Okay. Any questions about the golden and death cross? All right, no questions. Pretty simple, right? So we've covered using one moving average. We've also covered using two moving averages. Now we're going to cover another way of looking at moving averages by using three moving averages. Okay, the triple crossover. All right, so guys, you're going to be with me here for the rest of the day, because after three, I'm going to move on to looking at four moving averages, then 5, 6, 7, 8, 9, all the way to 100, right? And each of it has its own special way of looking at it. Okay, I'm kidding, guys, right? Too many moving averages just makes the chart very confusing. Okay, so triple crossover. The triple crossover technique uses three moving averages. The third moving average actually helps to avoid false signals encountered in the double crossover technique. So it's sort of I would think that most of you are Singaporeans, right? It's like a confirm plus chalk kind of thing, right? So you have you just want to double check, triple check, right, and ensure that this crossover, whether it's a golden cross or death cross, is really a real signal. So that's why a third moving average is included. So the most popular combination was actually mentioned by this gentleman, R.C. Allen, there, and he uses the 4, 9, and 18 moving average combination. Okay, again, we will need to talk to Mr. Allen to understand why he chose these numbers, right? Why specifically these numbers? But as mentioned in the slides, okay, there is a day trading thing, right? In looking at the daily chart, because it's the 4-day, followed by the 9 days, and then after that the 18 days, right? That's why he chooses this 3 period for the triple crossover, the triple moving average system. So how do we interpret this? Okay, clear market structure. We have the moving averages, right? As mentioned, the further away the moving average is from price, the longer term it is. Okay, so here we are, the example that we're given is 5-day, 10-day, and 20-day. So the blue line should be the 20-day, okay, the 20 MA. The black line, which is a bit closer to price, will be the 10-day MA. And then, of course, the red line, which is the most sensitive, is the shortest term moving average, which is the 5-day. Okay, so over here, there's a buy signal, right? Give me a moment, I have a question. John, you're unable to hear me. Just want to double check, okay, the rest of the attendees, you guys are able to hear me as well? Oh, okay. Now you can, right? All right, okay, thanks for that quick update, John. Okay, so back to this, right? We have the 5-period moving average that has just crossed above both the 10 MA and the 20 MA. Okay, so for the buy signal, the initial buy signal, right? You see the 5-day moving average above the 10-day and the 10-day above the 20 MA, right? However, if the 5-day is below the 10-day moving average, the signal is not valid, right? The signal is not valid yet. So what they're trying to say, okay, what they're trying to say is, this was the initial position, right? Let me just go back. This was the initial position, okay? And then after, where's my mouse? Okay, after price continues pushing higher, the position has changed a bit, right? The black and blue lines have swapped. The 5 MA is still at the top. The 10 MA is now in the middle. The 20 MA is at the bottom. So this system is saying that when the stars align, okay, in a proper order, this is a confirmed signal that the bullish crossover has happened. This is the best time to enter the market. All right, clear so far? So the opposite is true for the bearish triple crossover, right? So let's say clear market structure again, using the same examples, 5-day, 10-day, and 20-day. So currently the 5 is below the 20 and the 10. Okay, even though price has gone so low, but to be very certain that this is not a fake out, okay, we wait for price to further develop. Okay, now that the formation is the 5, 10, and 20, okay, in a order, in a very orderly manner, right? This is the best time to sell. Okay, so you have a bearish triple crossover confirmation. All right. So that is the triple moving average system. We have covered the single moving average system, the double moving average system, the triple moving average system, and now we are moving into the moving average ribbon system. Okay, so as I mentioned before, you guys can actually go and check out the moving average ribbon. Okay, stick around long enough with XM, and you also actually be able to see the famous Avramis River system. Okay, which really looks quite pretty, right? However, each traders have their own preference, right? So my own personal preference is really not to use more than 2 moving averages, right? I always believe too many cooks spoil the broth. But at the end of the day, okay, if a system works for you, please stick to it, right? Because there are many trading styles out there. What a scalper looks at is very different from what a day trader will look at. Likewise, what a trader looks at is very different from what an investor will look at. Okay, so there are many roads that lead to Rome, right? Eventually, I really hope all of us get there together. So the moving average ribbon system, okay, a very pretty way of using trend indicators. So how is it constructed? The moving average ribbon is constructed by combining 8 or more moving averages, capturing a variety of different time cycles. So an example over here is that generally 4 short-term exponential moving averages. So now they are using EMA. So a bit more weight given to the most recent prices. So short-term, they're using 4, 7, 11, 16. And then for long-term exponential moving averages, right, for the long-term time frame, they're using 25, 30, 35, 40. All right, so all using EMA. All right, so you can see that it actually does look quite pretty, right? So the short-term moving average, all right, the short-term group, the 4, 7, 11, 16, represents the short-term trader's view of the market. And likewise, the long-term average group represents the longer-term trader's view of the market. Okay, so by using this moving average ribbon and looking at how price, okay, moves around the moving average, the moving average trend, the moving average ribbon trend indicator, right? You can actually tell whether the short-term traders are on the short term shorting the market, whereas on the long term you could still be in a very nice uptrend. Okay, so that is really how the moving average ribbon is being used. So as mentioned earlier, okay, do you guys have any questions on the moving average ribbon? Right, I do not think that you guys will have any questions on the moving average ribbon. If you guys do, please feel free to sound out. If not, okay, it has actually covered a bit more on the topic that we do the Avramis River strategy. Right, so at the start of the webinar, I've said that, you know, this is a trend indicator session. So moving averages in a range, okay, moving averages in a range clearly will not work well, right? Moving averages work very well when the market is trending. However, in a range, please do not use moving averages. Why? Because you get a lot of false signals known as whipsaws. Okay, so you can see the trend is very nicely on an uptrend, but on a sideways, all right, Imagine over here, you break below, you sell. Immediately price reverses, stops you out, you take losses, and price is now above moving average, you buy. Right? And what happens? You're profitable for a little while and you think, yes, market is finally going in my uptrend direction. However, market reverses almost immediately, stops you out, you're in losses, breaks below the moving average, and you're like, okay, I have 2 consecutive trades that I've lost. Now price is below moving average. What do? Do I sell? Okay, and then you just say, let's try it one more time, right? Sell. And then you're going off into this gambling mindset. All right, probably entire martingale strategy, loading up more on each loss, on each trade, right? After every consecutive loss, and you sell, and after that you're stopped out again. You're like, oh man, you know, you sink deeper, right? No more martingale strategy. It's just revenge trading. It's like I'm all in kind of thing. Okay, and then after you buy, and you think you're hopeful, but price reverse stops you out. Bye bye trading account. Bye bye life. All right, so moving averages, not good to be used in a range. Always better to be used in a trending market. All right, guys, this is very key. Please remember this. Okay, remember this. So any questions on moving averages before we move on to the next trend indicator, looking at MACD? Okay, no questions at all, right? So I hope going forward, you guys would start, you know, asking yourselves every time you load up a moving average. It can be simple moving average, it can be exponential, it can be weighted, right? But whatever moving averages you guys are using, I hope you guys start asking yourself why you are choosing that look back period that you're looking at. Okay, why are you using 13 MA? Why are you using 50? Why are you using 200? Why are you using the 100? All right. Now let's move on to the MACD, moving average, convergence, divergence. So the MACD is actually developed by this guy called Gerald Apple in the late 70s, and it's actually considered one of the best mathematical tools, one of the best mathematical indicator. Right, in my experience, I would say that yes, I use the MACD extensively as well. I think it is a very powerful indicator to look at momentum, right? So I love the MACD. Okay, I really love the MACD, right? It's one of the best indicators to actually check for momentum. Okay, so let me bring out all the slides. Okay, so the MACD is known as moving average, convergence, divergence, but MACD for short is not McDonald's, right? I might have McDonald's for lunch. Developed by Gerald Apple, I've already mentioned this. It is a hybrid indicator that can be used as trend following or even a momentum indicator. Okay, a bit of, I'm just a bit picky over here, right? This is a bit just sort of reiterating the point twice. Okay, trend following, momentum indicator. All right, when markets are trending strongly, the momentum is strong, right? It's sort of saying okay twice, right? When somebody asks you a question and you're like, okay, you know, that kind of thing, right? So it is a hybrid indicator. Why? Okay, the better way of explaining the MACD is that it is used in a trend. However, the MACD allows you to see whether a pullback is going to happen within a trend. So let's say the general trend of the market is up, right? So prices are upwards trending. Okay, and then the MACD is able to give you a signal to tell you that, hey, within an uptrend, there is a higher chance for a pullback, okay, before continuing again on an uptrend, right? That is why I love the MACD, right? So it is a hybrid indicator, that's correct. But it's just terminology wise, just got to be careful of saying that it can be used as a trend indicator or momentum indicator. It's like saying it is the same thing. It can be used as a trend indicator or a trend indicator, right? So you just got to be a bit more careful about that. So how do we calculate the MACD? Right, a MACD calculation is a bit more technical. And what I like to say, what the analogy that I always like to give is, you know, many times there's no need to really figure out how to calculate the indicator. Okay, knowing how to calculate the indicator will not make you money. It's the picture the illustration I like to give is, if I'm going to pay you based on the number of trees that you chop down today, and I give you an X, are you going to understand where the X come from, where the X is manufactured in, whether it's going to be manufactured in Singapore, Malaysia, Thailand, Vietnam, China, right? It doesn't really matter, right? Knowing where the X is manufactured, knowing what sort of iron the X head is using, is not going to earn you money. At the end of the day, what you really want to know is how to use the X in the best way possible so that you can chop up as much trees as possible and give me my tree trunks so I can pay you. Okay, and I am not against, no, I am against deforestation, guys. Okay, so yeah, I just had to get that clear, but it's the best illustration that I can use out there. Okay, so the MACD is made out of two plots. All right, so you have the MACD line, which is essentially using the 12-period EMA minus the 26-period EMA. Okay, so that it's over there, right? So you have the 12-period closer to the price, 26-period further away, and then the MACD is plotted as, okay, the MACD always has a zero line, right? It always has a zero line. Always remember that it has a zero line. The MACD is unbounded, so it can go up to 200 over here. It can even go down to negative 200. Unlike the RSI and the stochastics, where it's really 0 to 100. Okay, so Usman, I think at the start you mentioned that you're using RSI. Okay, so RSI may look a bit like MACD, stochastics may look a bit like MACD, but they're different. Okay, the MACD is more of a momentum trend indicator, and also tells you where the pullbacks are about to happen. All right, so just want to point that out to you. So let me just pull out everything. Okay, so you see there's a difference. Okay, like I said, the MACD is calculated between using the difference between the 12 EMA and the 26 EMA. So if the 12 EMA is below the 26 EMA, right, you take the 12 minus 26 negative, you plot it right there. Okay, and then as you go to the next point, all right, when the 12 and the 26 are at the same value, right, of course the difference is 0, so the MACD goes back to 0, right? And then after that, if the 12 is above the 26, the value of the 12 EMA is bigger than the value of the 26 EMA, then of course it's plotted higher above 0. You join the lines together, you get the first line of the MACD, right, which is the signal line, okay, which is the main MACD line basically. And then we have the signal line, which is exponential moving average applied onto the MACD line. So it's a 9 EMA applied onto the MACD. So this red dotted line here is nothing but just a moving average of this solid green line. So it's like a moving average based on the difference of two different moving averages. Okay. So you have the MACD line, you have the signal line. So how do we look at the MACD line? How do we understand how to use the MACD? The first way is really looking at a center line crossover. MACD line versus zero line used for trend direction. So very straightforward. Okay, all you need to remember is above 0, bullish. Okay, below 0, probably I got the below 0 bearish, greater than 0, so MACD. Please forgive my ugly mouse writing. MACD above 0, bullish. All right, so that's essentially how the MACD is being interpreted. Okay, so very straightforward. This slide, we're done. Okay, so every time you see the MACD crosses above the 0, price is in a bullish environment. When the MACD is crossing above the 0, it's telling you that there is a build-up of bullish momentum, right? You can just say the momentum is increasing, but it doesn't tell you whether it's bullish or bearish momentum. Okay, so above 0, bullish momentum. Below 0, bearish momentum. All right, the next interpretation is using the signal line crossover. So what does that mean? Right, remember earlier back in our previous slides? Okay, the MACD has both, the MACD indicator has both the MACD line and the signal line. Okay, so the signal line is used to look for pullbacks. Okay, over here it says used for price corrections. Okay, and the MACD is never this beautiful in real life. All right, if there's time later, I'll show you guys on the charts. Right, but the MACD in real life is never this beautiful. Sometimes the signal line crossover below crosses the MACD above 0 or below 0, right? And that is the signal for pullback. I will not use price correction because it is not, again, I'm a bit picky here. This is not terminologically correct, right? It should be pullbacks. All right, so bullish pullbacks can occur when the MACD turns up and crosses above the signal line. So it's like that, okay? So MACD starts to cross over, okay? And then after the signal line crosses up, okay, the MACD. All right, but because both the signal and the MACD are below 0, this generally should be a pullback in a bearish environment. So it just means that price is in a bearish environment. We're seeing a small pullback, and price ideally should continue downwards. All right, the opposite is true. Okay, the opposite is true when the MACD is, let me just pull back the slide, okay, because when the MACD is above, right, and then the MACD crosses the signal line, but it's above, but both are above 0. So what it means is price is on an uptrend, and then there is a slight pullback, and then it should generally continue again. Okay, so any questions about the MACD and the signal line? Because I know some of you actually use the MACD. At the start, I was asking what sort of indicators you guys generally use. Jess, you use the MACD. Are you clear on this? Hopefully it clarifies some things up for you. Okay, so let's move on. We'll talk about the MACD histogram. So as you guys know, on the MACD is not just the MACD line and the signal line, there's also a histogram. Now, Gerald Apple that developed the MACD really just looked at 2 lines, and then we have Thomas Espray who comes in to develop the MACD histogram. He added on the histogram onto the MACD. Now, what does the histogram do? The histogram basically measures the distance between the MACD and the signal line. That's all, okay? That's all you need to know. It measures the distance between the MACD and the signal line. Okay, ideally, it's supposed to signal trend change well in advance of the normal MACD signal. All right, but as with all things, okay, it is generally less reliable. Right, like my watch that runs out of battery quite quickly. Okay, so how do we calculate the histogram calculation? It's just the difference, right? So an example, you have the MACD and the signal line here at the top, and you're just calculating the difference between the space. It is sort of a repeat of how the MACD line is calculated, right? Let me go back to the slide. It is a repeat of this. The MACD line is calculated by using the difference between the 12 EMA and the 26 EMA. Using the same concept, that is how we calculate the histogram, right? It is the difference between the MACD line and the signal line. Okay. So, in my opinion, okay, the histogram is not very useful, right? The MACD, just the best way to look at it is really to see whether it's above 0 or below 0. I know that there are people that actually look at divergences on the histogram, right? Again, if that works for you, please continue using it. All right, it's just that I don't find it particularly useful, but if it works for you, please continue using it. Don't just because of a random instructor on a webinar telling you that he doesn't look at it, you don't look at it. Okay? So how do we interpret, right? So the downward slant implies negative divergence between MACD and its signal line, and the upward slant is complete opposite. It implies positive divergence between MACD and its signal line. So like I mentioned earlier, people actually use the histogram to look for divergences. Okay, whether it's useful or not, debatable, but at the end of the day, as long as it's useful for you, continue to use it. All right, so at this point in time, we have a couple of minutes, so let's move over to the charts. I'm just going to show you guys a bit of histogram and MACD. All right, so I'm just going to pull out a random chart. Okay, so since we are on pound dollar, let's use pound dollar, and let's go down to the 4 hours. Let's take the MACD. All right, wait, I do have a template set. Okay, let's remove the EMA. Okay. Looking at the MACD, right? Now, when the MACD is above 0, okay, again, the disclaimer here is that no indicators work 100% of the time. If it's 100% of the time, it's the holy grail, then, you know, everybody will use it, then it loses its edge, and then we're back to square one again. Okay, MACD works nicely, but it doesn't work 100% of the time. All right, but the idea is always the same. All right, let's look at these areas. MACD and signal line crosses below 0. What happens? Price moves out of a range and breaks out to the downside. It goes down, right? So of course it's at the bottom, okay, and then we see a crossover. This is a pullback, telling us that, you know, in a bearish environment, price is doing a pullback. Okay, but of course the MACD and signal line continues higher, and when they finally are both above the 0, okay, it confirms that in this area, price is now in a bullish environment. Okay, so if I were to do a replay, something like that, and you have to look at how the chart is playing out, it's very clear that when we are below 0, we are ideally in a downtrend, right? Lower highs, lower lows. So we're still in a downtrend. Here is still a lower high compared to here. Okay, so still, you know, in a bearish environment, right? At this area, we're in a bearish environment. However, now because we've crossed over, okay, it's telling us that maybe this may not be a lower low, lower high anymore. You know, price has gone into the bullish momentum territory, and bullish momentum is building, right? So prices could very well go higher, and this is exactly what happens. So prices go higher and surpasses the previous high, right? So now prices are above, we are in a bullish, let me just clear all drawings. We are in a bullish environment, prices are above, we are in a bullish environment, right? So prices are going higher. We have the signal line, okay? The signal line, this shows a pullback, all right? And then the MACD and the signal line is dropping lower, but they are still above 0, which is why you see that prices do not drop drastically. It's sort of drifting downwards slowly until what happens? Until both cross below the 0 line, showing that there is now more bearish momentum than bullish momentum. This area would be a good area to start looking for selling opportunities, right?